Hello YouTube, welcome to my channel. I'm Brent Bowers and this is My Money. As most of you already know, the market volatility over the last year has been absolutely wild to say the very least, and it's gotten a lot of people a bit on edge. There's been floating around speculation that there's going to be a massive market correction sometime in 2021, and the situation is going to be nasty. And why, for the average American investor, this means precisely jack shit. Okay, so let me explain what I meant by that. The overall expectation of a market crash isn't as important as people say it is, despite the mass narrative bombarding you that if you don't liquidate all your holdings and put your money under your mattress, you're gonna lose all your post-April gains of last year. Now, understandably, it is almost impossible not to get caught up in the whole market crash, we're all doomed, we're gonna lose all of our money rhetoric. But is there going to be a crash lingering right around the corner? Well, unless you have a crystal ball, nobody really knows, except for we have all the evidence to prove that there very well could be. COVID-19 is still very much a thing. We still have stay-at-home orders. A lot of people are working from home, teleworking. Restaurants are still at half capacity. There's been layoffs. There's been foreclosures. Restaurants are still in flux. Gyms are still in flux. Certain stocks are overvalued, certain stocks are undervalued. So I guess that means we have to watch out for the big bad bear coming into stealing your Bitcoins. Well, not really. You see, with all the bad things 2021 has going for it, the preeminent fiscal data actually paints a very, very different picture. The market is due for a massive correction, of course it is. However, political and financial pundits have been saying that for decades.
Companies are very nervous about what's going to happen with earnings this year.
We're down by between 3 and 4.5% generally across these markets.
Let's talk about the speed with which we are watching this market deteriorate.
We're red everywhere, essentially, down by 4-5%.
We're down over 16%.
Dow at the same time has fallen about 18%.
All talked about it, but this is a historical day, the biggest drop we've seen since that crash in 1987.
You're seeing the stock market move well below that. Right now, it looks like the Dow is down by about 6.9%.
What I think is going to happen is not a market crash, but more or less a market correction with smaller bubbles here and there. Sorry, no breadlines. So with that being said, here is why you should not be worried about your finances in 2021. I know that might sound overly positive given recent events, but I like to think of it as being cautiously optimistic, to say the very least. So here's what you can expect from 2021 and ways to navigate this magical year financially. First and foremost, it's very important to understand how markets work and the ebb and flow of the economy. By this understanding, it becomes a lot easier to navigate hyperbole in the media and to navigate the ebb and flow of the markets. So from a top-down viewpoint of everything going on in the media, when it comes to investing in finance, market crashes, dips, recessions, corrections have produced some of the worst financial situations known to mankind. I mean, we can count them. The 1929 Great Recession, the 1987 Black Monday, the 2001 dot-com bust, the 2008 housing crisis, and in 2020, the Corona crash. However, on the same side of things, it has also produced some of the best opportunities known to mankind. In direct relation to this, I've always loved this quote by Warren Buffett that has stayed in my mind completely rent-free for as long as I can remember, and that is, be fearful when others are greedy and greedy when others are fearful. I always knew what that meant on the surface, but now more than ever, I think it takes a little bit more analysis, especially during the time frame we're currently going through. One of the key major points that I do desperately want to drive home is people in the stock market investing, they don't see opportunity the same way. I could see opportunity very, very differently from somebody watching this video. We can call it whatever you want to, call it foresight or intelligence or intuition or market knowledge, but if there is in fact going to be a correction or a crash, there's only two ways about it: negative and positive. So why not benefit from it? Don't be fearful, be greedy, go out there and find a way to get out of a situation. That's exactly what Warren Buffett is saying. Market correction? Yes, please. Well, why? Because then you can purchase stocks at cheap. So you have to think about the positive things that are going on instead of just the negatives. A crystal clear example of this is what happened recently, the corona crash of 2020. The market began to take a dip in late February and ended early April, and this hurt a lot of people, including myself. However, I wasn't down about it at all because this is exactly the moment in time where you should have been taking a position. Get ready to buy the dip and putting in your money where stocks are artificially cheaper than they had been previous weeks ago. Of course, this example brings us directly into the first thing you should be doing in 2021 is get ready to buy the dip, or another way to say that is have cash on hand. Instead of worrying about your sole current financial position, get ready to buy the dip when there is in fact a correction.
Brent, are you telling me to time the market?
Of course not, that would be sacrilegious, but think about it, if there's a market correction of 20%, that would be the moment in time to look at market fundamentals to see if this is an ongoing thing or if it's just something based out of fear. If it is the latter, expect a rebound in the near future where you can make easy money. Okay, so why would I even bring this up as important or as relative? Well, consider the following. As stocks go through a rout, they become particularly risky due to volatility. However, if you take the time frame and pull back over the long term, they become a lot more attractive to people that have a long-term investment strategy. And this is particularly good if you don't need to liquidate any of your assets anytime soon. The longer the time frame, the better. What I'm actually mentioning here is a financial term that I'm pretty sure a lot of you know about called rebounding, and it's exactly how it sounds. A rebound is just when a stock comes back up again very rapidly from an artificial lower level. This is especially predominant when a stock goes through a recession and usually it coincides with abnormal market trends. All in all, this virus has really shaped the economy into something that is in fact abnormal. We have GDP down 12% in one quarter, then up 33% in the next. We have unemployment that's like 12% in this month, and then 6.7% in that month. We have department stores that can't open. We have restaurants that are still in flux. We have gyms that are shut down. People are staying at the office. People are teleworking. People are locked in their homes. You can't visit, elderly people because they're stuck in their homes, staying there, wearing their masks, doing this thing, and it's become really difficult. But me, like a lot of people, are optimistic about the economy going back to normal, more so than it has been in recent times. This concept is actually backed up by another financial term called price waves, often used in conjunction with rebounding, that suggests that any time that there's an artificial price swing in the stock market, it is usually predictive in short terms that it's going to be coming back to normal at the fundamental level. Even if you have an open position during a downfall, you can actually buy the dip, which relates to another strategy called averaging down. This is used very, very carefully, and it's also promoted by a lot of professionals that say this is a good idea if you want to increase your equity holdings on the very, very cheap. And it's also a way to reduce your net average price per share. However, with all things in finance and investing, it's also a caveat. Why? Because it needs to be used in conjunction with price control. So if you're just gonna keep on buying the next lowest level, it's gonna go to zero and you're gonna bottom out. I only recommend this strategy with individuals with large portfolios over a large period of time, rather than individual people with one stock over the short term. Again, it is very important. You don't wanna be catching a falling knife. People say that a lot. Due diligence is in fact key here. As the months continued in 2021, the main question of what to do with my current holdings plays a critical role in an individual's financial well-being. And since uncertainty is one of the biggest variables we have to go off of, it's better to be safe than sorry and just take all of your assets and transfer them into US treasuries and bonds. That way we can just completely mitigate risk and even out the volatility, right? Not quite. And this of course brings us eloquently into our next point, number 2, and that is don't put all your equity into bonds. As it might be common knowledge to suggest that bonds and US treasuries of that nature are a lot safer than stocks and equity, which is true. However, they're not without their fallbacks, and you really don't want to be stuck in them during a market correction. In any case, you don't want to be in a situation where you're frantically moving 100% of your assets on a weekly basis back and forth between equities and bonds. While bond funds and other conservative investments have surely shown their weight and their clout during times of uncertainty, investing like a hermit isn't actually synonymous with growth. You see, people tend to forget is the more safe an investment is, the less risk, but the less risk, the less money. I know a lot of people that are attempting to time the market by moving their equity funds into the bond funds when the market takes a dip, and then vice versa to catch the market upswing. This is a dangerous game to play, and you definitely don't want to be a part of it. Of course, the odds of making the right move are pretty much stacked against you, and you don't want to be involved into chasing the market. I say this because the odds are pretty much stacked against you, and you definitely don't want to be in a situation where you're chasing the market. Even if you are successful once, it's pretty much almost impossible to repeat this over and over again, especially during a recession. A far better strategy that I tell everybody that's currently experiencing a lot of frustration given the markets is to already just transfer your assets into an already developed mutual fund or a portfolio that has a large mix of stocks and bonds. Bonds to even out the market and the risk and the volatility, and then of course stocks to participate in the market upswings. In addition to this, another strategy, if you don't want to do that, is to participate, and if you want more equity, into defensive stocks. Companies that it doesn't matter what the market is doing, they actually perform very, very well during a recession, such as Procter & Gamble, Coca-Cola, telecommunication giants like AT&T and Verizon, even Amazon has become pretty defensive over the last year. All in all, the reason why I say this, because if you actually had to do something within your current portfolio, within your current stock holdings, it would be just to decrease your equity holdings and to invest during the downturns. Another interesting concept that I really want to drive home is that recessions are simply just a part of the overall business cycle in the United States. It's very much an average thing to do, even through a pandemic like this one. It's not without its downsides, but it's not without its upsides either. After all, a lot of recessions are brought on by interesting reasons. You have like political turmoil, you have trade confrontations, you have lack of economic activity, you have stalemates in certain sectors of the market, you have banking regulations, you have certain states that are kind of in flux, you have the weather, political turmoil here and there. A lot of things contribute to a recession, so it's just an average part of ups and downs in the overall market trend. However, one of the things that I would like to count on is the positive mindset in America, because after all, we've recovered from all 47 recessions back to back to back, again and again and again. So just keep that in mind when somebody says,
Oh my God, we're gonna go through a recession.
And finally, this brings us to my final recommendation. If you stayed this long in the video, congratulations, I commend you. My final recommendation, and that is don't panic, stay the course. Nothing financial, it's more of a behavioral thing. Don't panic, stay the course, everything's gonna be okay. Or do nothing. You can also do that too. If you're well diversified, you don't have to do anything. Okay, so I say this phrase specifically during this time because it fits so well into the current narrative of this year specifically, and it means a lot to just stay calm and to understand finance from the outside in and not get too divvied up on the day-to-day activities, especially when you take a bunch of flack from the media telling you to panic. It's okay, stay the course. Of course, I don't want to get too sidetracked here, but I do want to bring up a valid point of someone that we all know, Warren Buffett, one of my financial heroes. He is known for being one of the best, if not the best, investor in the stock market, in markets, in the economy of all time, Warren Buffett. And it's interesting because during a lot of interviews that he has with reporters or people that talk about him on YouTube, they rarely bring up his key abilities. Not just reading the markets, not just reading financial statements. I'm talking about his cool head and his patience. Warren Buffett is very, very, very patient and is cool and collected, which is exactly what you have to be going into 2021. I say this specifically because a lot of people know, and I hope you know as well, that the stock market is nothing more than increases and decreases, spikes and dips, and crashes and recessions and recoveries. And you know, you're never going to see Warren Buffett in an interview losing his mind, going crazy because the stock market dipped 5%. Why? Because he, like hopefully most of you, understand that this is just the normal part of the game, and to lose your mind over this is just ludicrous, and you just need to stay calm and stay the course. And if you don't believe me, take this picture into consideration, that this is just a normal part of the cycle. If you take the Dow Jones over the last 120 years from a large perspective, bottom to top, and you compare that with the 1929 Great Recession, you begin to see something interesting. If you overlay the two charts, the Great Recession, in terms of the overall market trend, is a drop in the bucket. Yes, it ruined people's lives. Yes, it was horrible. Yes, it lasted 10 years. But in the grand scheme of things, it's important to look at the market trends from a decade perspective rather than a month perspective. You don't want to have the short game mentality. You're going to lose a lot of assets that way. Take a step back and take a breather and realize that things are going to be okay, because the stock market, the Dow Jones and everything else, that have never decreased and stayed there. They have always recovered. I mean, take the Russell 2000. It hasn't gone down. It's always recovered. The S&P 500, the Russell 2000, and all of these other indexes have never gone to zero and stayed there. They've always recovered again and again and again over the long term, over the last 120 years. And the worst of the recessions, the worst of the crashes, it's only on average lasts between 4 to 15 months and 10 years at the very worst of it. But if you are in fact like me and you want to mitigate risk as much as possible, mitigate taxes as much as possible, but also like to participate in the stock market, you'd be better off taking Warren Buffett's advice and just betting on brands, betting on America specifically. Take the S&P 500, for example. It's gonna even out over a long period of time. You'd be better off just investing that way. Okay, so in summation for you guys, number one, have cash on hand, get ready to buy the dips. Number two, don't stuff your money into your mattress and don't put all your money into US treasuries. You wanna have enough exposure to the market to take part in the recovery and upswings. And number three, most importantly, just stay calm and ride this thing out. Everything's gonna be okay. And that is all I have for you guys today. And if you wouldn't mind just taking the like button and drop kicking it across the room to let YouTube know that I'm actually alive on this channel. And if you like what I had to say, consider being a subscriber. And that is all I have for you guys today. I'm Brent Bowers, and this is My Money. I will see you guys in the next one.